Macquarie Group has announced a net profit after tax of $2.3 billion for the half year ended 30 September 2022. 72% of income was earned outside Australia. The group declared an interim ordinary dividend of $3. Shemara, welcome and thanks for joining us. Macquarie delivered a strong first half result against a backdrop of more challenging market conditions. The result was well balanced between annuity style and markets facing activities. Can you explain what drove performance in the annuity style activities?
Sure, and as you say, Laura, we did have a 50-50 contribution this year from the annuity style and the market facing, but together they all delivered a really pleasing result with a 15.6% return on equity in this challenging environment. Indeed, all good contribution in this environment. It was great to see in Macquarie Asset Management that our private markets business has now got to record equity under management of over $188 billion after raising $22 billion in this half, which is quite a material record for that business. So really stepping up to deliver for its customers and build its franchise. And in addition to that, we brought the Green Investment Group across to the asset manager, and that integration's going well. And there was some good realisation in the first half from the Green Investment Group. And then in the public investment side, our assets under management stepped up a lot because we did those acquisitions last year, so that's coming through. But we've had the offset in terms of market movements pulling down assets, and then pick up from what has happened with foreign exchange. So overall good growth of franchise in the asset manager, and then banking and financial services, again, ongoing growth of their franchises. Their customer-focused digital banking offering continues to drive growth in their home loan portfolio at really good credit quality, business banking portfolio. We've also attracted more funds onto our platform and been able to grow our deposits to a record figure as well, material step up in supporting that growth.
And how about the markets-facing activities?
In market-facing as well, we had good franchise growth. So commodities and global markets, there's three business lines in there. The asset finance continued to make a solid contribution. And then in financial markets and commodities, we experienced greater volatility, which created more need for our services from customers. And so we were able to step up and really deliver to that. So we had a very strong step up in CGM's results compared to the prior corresponding period, as we did in Macquarie Asset Management and Banking and Financial Services. And then Macquarie Capital obviously experienced a very challenging environment at the moment in activity levels being reduced and fee revenue being down. But what we've been able to do is grow our principal investment income, and that's by growing our credit book, which is pleasingly really stepping up now, and very quality book. And also in terms of the equity side, we had some good realisation in the first half as well in that business.
So the group continues to maintain a strong capital position. Does that reflect your view of the global economic outlook or the opportunities you see ahead?
Well, as you know, through the cycle, we always maintain very prudent capital and funding positions. And with our results, you will have seen that our surplus capital stepped up from $10.7 billion to $12.2 billion at the end of the first half. Our CET1 ratio at the bank was at 12.8%. We're very well funded in terms of our term funding exceeding our term assets, and we have $100 billion of cash and liquids. So we're sitting at a particularly strong financial position, but it's what we do through any cycle. However, given the uncertainty in the outlook, I think it particularly behoves us to be able to respond.
Looking out over the remainder of the year, how do you see the outlook for Macquarie's businesses?
Yeah, well, if I take that group by group, and we talked about the capital and funding, it's basically here to support all our groups to be able to respond in whatever comes. And so the asset management business, we expect our base fees to be broadly in line with last year, given that financial markets have brought down the value of assets in the public markets despite the investment in and raisings in private markets. In terms of net other operating income, we had a very large contribution from MIC last year, which won't repeat, so we expect that to be down. And the same with the Green Investment Group contribution. We had a very big realisation in the second half last year. We had a good realisation this first half, but we don't expect it similar in the second half, so that should be down. In banking and financial services, the ongoing growth in our loan books, the funds on platform, the deposits should drive earnings. It will always be subject to competitive dynamics impacting margins and also investment in technology, etc., as we grow the platform. And then turning to the market-facing businesses, Macquarie Capital, as we've discussed, activity levels down, so fee revenue down, but our private credit book continues to grow, and we have realisations, albeit not at the level of last year. And finally, in commodities and global markets, there we're seeing, as I said, continued contribution from the asset finance business, but step up in contribution both from financial markets and from the commodities business, which we particularly saw strong contribution from in the first half. So all up, the business, driven really by the operating groups, and in terms of central areas, our compensation ratio and our tax rates we expect to be in line with historical levels.
And finally, Shemara, what's your outlook over the medium term?
Well, for the medium term, as we always say, we think we're very well positioned, and as we have been through the cycle with our very diversified capabilities we have across our businesses, both in sectors and geographies, and that's supported by, as I said, our prudent funding and capital position, our investment in technology to uplift our platform, and our strong prudential risk management framework that we've had throughout the period. I think that should position us to deliver ongoing positive returns. We certainly over the cycle have been delivering mid-teens returns for some time now, and this year again, after our $12.2 billion surplus capital, still delivering 15.6%.
Thank you, Shemara.
Thanks, Laura.